When reading Morgan Russell's book on financial psychology, we understand something about money that, if we stop to think about it, is quite obvious, but most people don't see it that way, discarding all possibilities of financial success. Financial psychology is not a technical skill, but a personal one, where behavior is more important than knowledge. This is completely opposite to what we often hear, as we always think about money in physical terms, thinking about salaries and how much we receive each month, only seeing tangible numbers. But it's incredible how the entire economy is primarily driven by people's behavior, and you will see why. A simple example is about debt. The main cause of people's debt is their own behavior. To avoid debt, we don't need to understand how interest rates and monthly installments work, we need to understand emotions. For example, insecurity makes a person spend their money to show others that they have a lot of wealth, accumulating debts in the end. In the end, what dictates everything are behaviors driven by emotions. If you already like the idea of this video, please leave a like, and let's go. Each individual has a different view of money because it is shaped by the experiences they have gone through. An example from the book is the difference between someone who has spent most of their life in poverty and someone who is the child of a wealthy banker. These two people think about risk and reward in completely different ways. A banker's child who was born rich and always lived in an environment where lack of money was never the problem often has no fear or hesitation in taking risks and losing some money, for example. Whereas someone who has always faced financial difficulties and grew up hearing that making money is extremely hard and that money doesn't grow on trees mostly seeks financial security throughout their life and is unlikely to think about investing because, in their view, it's too risky. But it's not just that. There are many lessons within this subject that you will learn now, so pay close attention. You must have heard that humans are never satisfied, and nothing is ever enough for them. Whenever they earn more, they want even more. So, you will understand through the story of Gupta and Madoff, who were both rich and lived very well, being multimillionaires with assets over $100 million. However, after a few years, they lost everything due to involvement and fraud. They literally threw it all away because they wanted more and more, acting out of greed. They definitely had no idea what was enough. Of course, this was an extreme example, but it's very common to see similar behaviors out there. However, they are not limited to extreme cases. For example, people addicted to lottery gambling think that what they have is not enough, and instead of investing in something concrete with lower risk, they keep losing money every week in the hope of becoming a millionaire by luck. And look at this, to win the lottery, the chances are infinitely lower than most investments. Doing a simple calculation, we know that the probability of hitting all the numbers in the Mega Sena is only 1 in 50 million. So, how should we really deal with money? When dealing with money, the hardest thing is to stop constantly raising goals. It's the old story of a person earning a salary and always wanting a raise, never being mentally satisfied with what they earn. For example, someone earning $3,000 lives their life spending all $3,000, thinking it's too little and wanting to earn $5,000. But if this person starts earning $5,000, they will continue to spend it all and dream of earning $10,000. I used the example of a salary, but this can also happen to people who earn millions monthly. So, be very careful. If your desire to earn more makes your ambition grow faster than your satisfaction, this mainly happens because of social comparison. You will always know someone who earns more than you, which makes you compare and think you don't have enough money. Of course, it's extremely important to strive for financial growth and earn more, which is literally what I encourage the most here on the channel. But never let it become an insatiable quest for earning more and more, making you blind to the risks ahead. And now comes the crucial part. If you want to have more money, envy investing in something high risk, thinking about the big returns, or betting on something completely risky just to see the millions you can get, like in the case of the lottery. Let's learn from the best. When it comes to investments, it's impossible not to mention Warren Buffett, the world's greatest investor. I've even made a video about him on this channel. In short, what the greatest investor in the world did and still does to this day, do you think he went after high and quick returns? On the contrary, he has been investing since the age of 10, regularly investing in the stocks he bought years ago, accumulating nearly $100 billion. What sets Buffett apart from investors who seek quick returns is his behavior. Have you ever thought about how many economic crises he has been through, and yet he continues to invest because he knows his strategy works? He focuses on the long term, investing in large companies that are likely to grow. He never focused on taking risks to obtain exorbitant gains. Look at his wealth chart from his adolescence to old age. Notice the snowball effect he built throughout his life. Now, see the difference between getting rich and staying rich. Making money is one thing, but staying with money is a completely different thing. To make money, you must take certain calculated risks, and be optimistic and bold many times. But keeping the money you earn requires accepting that past successes may not repeat forever. This brings us to the survival part. Survival is the ability to remain active for a long time without giving up or stopping halfway. Consistency is the key to the strategy, whether in your professional career, business, or investments. This is exactly what Buffett did throughout his entire life. This is the mindset we should have when it comes to money. Never forget this concept: more than big returns, what I want is to be bankruptcy-proof. And if I'm truly bankruptcy-proof, I believe I'll have the highest returns because I'll be able to stay in the game long enough for compounding to work wonders. If you can achieve reasonably good returns every month, you will fare much better compared to those who have exorbitant returns in some periods and significant losses in others. Being bankruptcy-proof is a luxury, especially in times of crisis. Just imagine if you're already investing every month and have a certain steady monthly return, but then you face an economic crisis with soaring inflation, stocks of major companies plummeting, and the dollar rising. What would you do? Would you sell your stocks like all short-term return-focused investors, or would you continue to invest even in a crisis, like Warren Buffett, thinking about the long-term effect? Of course, you should study the company thoroughly before investing. Taking an example from 2020, which was a recent global economic crisis, we see in these charts the stocks of major companies in March 2020 and now in 2022. Look at the sharp market decline during that time, and a few months later, we see it readjusting and returning to a common level. The book also mentions a joke among pilots that says, "Hours and hours of pure tedium punctuated by moments of deep terror," and that's exactly what happens in investments. This is very important. Your success in investments will be determined by your behavior during moments of terror, not during long periods on autopilot. The idea is to make a reasonable decision while everyone around you is going crazy. If you want to improve your financial life with the best books on the subject, subscribe to this channel now. Peter Lynch, one of the best current investors, says if you excel in this business, you'll get it right 6 times out of 10. You won't make the best decisions all the time. Do you think Buffett accumulated his fortune by luck, getting all his investments right? He also went through various periods of crisis and chaos. Another investor, George Soros, says it's not about being right or wrong, but how much money you make when you're right and how much you lose when you're wrong. That's the main idea when it comes to investments. From the moment you start earning more, spending less, investing your money, receiving returns from your investments, and reinvesting, you will form a small snowball that tends to grow over time. Even if you make investment mistakes at times, everyone dreams of waking up one day and thinking they can do whatever they want, buy whatever they want without having to work. And that is certainly the highest form of wealth. The freedom that money provides is its greatest value. But if you already set aside your money and invest, you may already have a certain degree of wealth. To better understand, let's look at the levels of wealth discussed in the book. Level 1 is having the possibility to take a few days off work when you're sick without compromising your finances. Level 2 is being able to wait for a better job opportunity after a job loss without having to accept any available job because you can comfortably cover your expenses for several months without working. Level 3 is having a reserve of 6 months' worth of your monthly expenses. For example, if your monthly expenses are $1,000, you have $6,000 saved, so you can stay calm during major crises. Level 4 means choosing to work for a lower salary with more flexible hours, such as opting for part-time work. Level 5 is being able to retire whenever you want, reaching the highest level of financial freedom. Remember, this is not a rule, it's just a way to illustrate better. Comment below if you're at any of these levels, and let's get into it. If you can't save money to invest and end up spending everything every month, consider this phrase, which, in my opinion, is the best when it comes to saving money: Spending money to show people how much money you have is the fastest way to have less money. So, if your focus is to have money and keep money, you should focus on earning more and accumulating wealth, which is different from fortune, and you'll see why. Fortune versus wealth. When we see a mansion with luxury cars in the garage, we assume that the person living there is wealthy, and yes, wealth is related to current income. It's the income that allows a person to afford and maintain that expensive lifestyle. That's why they are considered wealthy. But fortune is different, it's something we don't see. It's the money that hasn't been spent yet, the luxury car not purchased, the mansion not bought, the trip not taken, and so on. But how can you accumulate fortune? A good analogy from the book is exercising. Exercising is like being wealthy. For example, you've worked hard at the gym, come home, and think, oh, I deserve a pizza. Fortune is saying no to that pizza. In other words, it's earning money and not spending it on unnecessary and frivolous things that will delay your financial success. It's challenging to do this consistently, you need a certain level of self-control. Accumulating a fortune has little to do with your emotions or investment returns and much to do with how much you save regularly. People successful in personal finance tend not to care much about what others think of them. I talk a lot about this in the video I made specifically about this part of the book. If you're interested, I'll leave a link above. Everyone who invests or plans to invest in this market should understand that things change over time. Nothing stays too good or too bad for long. From time to time, the economy goes through ups and downs, and those who stick to the plan until the end win. Now, let's imagine two people, Joao, who works all day in a store as a salesperson and works as a waiter at a restaurant at night from Monday to Sunday without a day off and sleeps poorly every day but earns his $3,000 per month. Then we have Rodrigo, who works only 4 hours a day and earns $600 per month because he still lives with his parents, and for him, a low salary and working long hours are acceptable. Working long hours with no rest is one of the reasons people don't stick to the plan long enough. When it comes to investments, one of the reasons people don't stick to the plan for long enough is the seduction of pessimism. When it's said that a major crisis is looming, it's all over the news, every newspaper and media outlet acts as if we're on the verge of a complete catastrophe. However, when the projection is for significant economic growth, it's rarely discussed. This happens because losses have a much more significant impact than gains. That's why you should maintain balance and understand that a loss is just a bump in the road. If you like this video, make sure to leave your thumbs up and subscribe for more. Thank you and see you in the next video.